And if you start to look at what's going on fiscally in the US, then you really start to worry about how robust maybe financial asset markets are, or conventional financial assets. Now, we've always thought about bond markets. We've thought for the last 30, 40 years, bond markets being the safe asset, particularly the US Treasury. I think the point being is that is certainly true if you're in a disinflationary or low inflationary environment. If you're in a higher inflationary environment, it's not entirely clear that bond markets, and particularly treasuries, are the safe asset anymore. Now, legislators and regulators may want treasuries to be the safe asset, and they may dictate that they are the safe asset legally for banks and insurance companies. But for the average investor who's not compelled to follow those guidelines, maybe start to look at other assets. And if you go back to the inflationary 1970s, it was things like commodities, gold, real assets that were actually much better safe assets in a higher inflationary environment. One of the things to look at is the extent to which bond markets and stock markets are correlated on the way up and the way down during periods of high inflation. Their correlations tend to go up. So bonds are not a diversifying asset during those periods. And bonds in particular tend to be quite poor performers. So I think that's one of the things that we've got to start thinking about. The other thing is that, against this background, to try and put numbers on this, are we looking at a seriously much higher rate of inflation in the world economy than maybe people are judging? Now, I would suggest that it's not radically higher, but it's sufficiently higher to actually warrant some concern about conventional asset allocation. And that tells me that the 60-40 model of equities bonds is not the right one to have. And you should be diversifying more into things like gold and probably cryptocurrencies, notably Bitcoin, as some way of hedging that. Now, if you look at the US break-even inflation market, which is a way of judging long-term inflation trends, although my comment's going to be probably slightly wonkish, the problem is that if you look at the break-even inflation rate from the TIPS market, which is something you can actually work out by stripping the yield on the TIPS, the Treasury Inflation Protected Security, the index-linked bond, from conventional bond yields, you get a number there which is suggesting that US inflation, long-term inflation, has already come down to about 2%. Now, that is probably the wrong figure. And the reason I say it's the wrong figure is the Treasury market itself looks to be very distorted by what the US Treasury is doing. Now, I don't know whether we can move to the slides and move a little bit further along, and I can try and adjust, or I can adjust these, Anthony. So if I go along here a bit more, let me go back one. Right. This is the thing to start thinking about what the Treasury is doing in the US. And this, as I said, is somewhat wonkish, but because it's wonkish, it doesn't necessarily mean that you shouldn't try and understand it, because it's very important. And this is showing the composition of US debt issuance. Now, this is showing the proportion of Treasury bills, which are very short-dated debt, up to 1 year. They don't pay a coupon interest rate. They basically are securities that redeem at par. So what this is showing is that the percentage of bills that are being issued by the US Treasury is on an upward path. Now, the long-term guidelines that many experts or pundits have thought about is a range of between about 15 and 20%. Now, we're above that, and it looks to me as we're moving towards, remorselessly, towards a level of nearer 25%. Now, why is this a particularly important factor? It's important in two dimensions. One is that the question to ask is who buys these bills? And bills tend to be bought much more by banks and generally by credit providers. And if banks and credit providers are buying government debt, that technically is monetization. So it's the equivalent of printing money. So the very fact that they're issuing Treasury bills, and slightly beyond that, they're also, in terms of their coupon issuance, skewing the issuance of coupons towards shorter dated bonds. So in other words, what I would say is, to wrap this up, there's there's active duration management going on by the Treasury here, and they're skewing issuance away from longer dated coupons towards these shorter tenors. Now, what that means is that there is a distortion in the Treasury market. And as I keep saying, this is wonkish, but it's really very important. And what this shows is, if you look at this graph, it shows what I've called the true risk-free rate, okay? And that's the red line, which is measuring what you would infer the Treasury yield to be if you benchmark or bootstrap the Treasury yield from the agency mortgage market. So what we've done here is that we've adjusted agency mortgages. Now, agency mortgages are basically mortgages that are issued by Freddie Mae, Freddie Mac, the so-called government-sponsored enterprises in the US. They're a government-backed instrument, so they're like a risk-free Treasury, but they're a truer guide right now to what the yield on the 10-year should be. And you can bootstrap this implied yield or synthetic yield from the agency mortgage market, which is shown in red. So what that's telling us is actually that if you look at the degree of or the yields on the US Treasury market, they should be nearer 5% right now than the nearer 4% that we're looking at actually in reality. So there's 100 basis point spread, at least 100 basis point spread between actual yields and what fair value yields should actually be. Now, that's a puzzle, and it explains an awful lot of the anomalies in markets, such as why the yield curve is inverted and why the yield curve has never been a great predictor this cycle for recession or whatever. As you will recall, a lot of pundits in the US have been saying for a long, long time, this inverted yield curve is going to cause recession. It's what it's signaling. Okay, and there's various nuances people put on that. So when the yield curve begins to steepen, as it is now, they say, well, that's always a sign that recession is about to hit. Well, wrong. The yield curve has always been a flaky predictor anyway, but it's really distorted now, because if you put into your calculation of the yield curve this fair value yield that I've calculated, not the actual Treasury yield, you'd find that the yield curve never inverted at all. In actual fact, it's stayed positive and it's starting to steepen. Now, why is that going on? And if I can shift to this next slide, this is the reason that you've got this feature going on. The black line is the growth rate. Sorry, the black line is the yield suppression that you're getting in the Treasury market. It's happened before. So you've got 105 basis points or so of yield suppression now on that right-hand chart, which is telling us in black and white terms that the yield on the US Treasury bond, the most important yield worldwide in financial markets, is about 100 basis points, in other words, 1 percentage point below where it should be. Okay, so there is active yield suppression going on, and that active yield suppression is because Treasury issuance has been skewed towards the front end of the curve. In other words, there's been a lot of Treasury bill issuance, a lot of short-dated coupon issuance. And you can see the correlation between those two lines. Very similar thing happened in 2008 with the global financial crisis, where yields were suppressed by big bill issuance then, as the Treasury embarked on huge spending and had to finance it very quickly. So again, you saw in the COVID crisis very similar features, and we're seeing it again now. Now, what does that mean? As I said, it means that the yield curve is distorted. It means that the Treasury is issuing a lot of short-dated debt. That is liquidity creating by definition. And the third thing that comes into this is that if you look at this chart, which is maybe the more worrying of the lot, it basically shows two calculations of future inflation in the US. Now, the orange line is what the break-even Treasury inflation protected security market is telling us. So that's the break-even inflation rate, the implied inflation rate that the bond markets are assuming right now. And you can see that it's basically very close to 2%, which is exactly the criteria that, or the benchmark that the Federal Reserve have targeted. And this is giving Chairman Powell great comfort to say, I'm going to cut interest rates. And he will. The black line is the University of Michigan Consumer Survey, which is basically saying, what do consumers expect inflation to be over the next few years? And that or both those two criteria on the measured on that left-hand scale. Now, the dotted line is our estimate of the true break-even inflation from the TIPS market if you use this new calculation for Treasury yields, not the one that's actually prevailing. And you can see there that the dotted red line is much more in line with the Michigan survey. It's suggesting what you're likely to see is 3 to 3.5% long-term inflation. So this is not hyperinflation by any means. But what this is basically saying is that you're not getting particularly attractive real yields right now in treasuries. And if the Federal Reserve starts to cut interest rates as they're planning to do, that's going to disappear even more. So the underlying level of inflation in the US economy is already well above what people are expecting. And what that means is that you've got to start thinking about seriously about monetary inflation hedges. Now, another thing that I've been saying, over recent months and years, is that you've got to distinguish as well between high street inflation, which is implied here in this chart, and from monetary inflation, which is always faster, because monetary inflation doesn't just feed the high street, it also feeds asset markets. And it may well be that monetary inflation is moving at a clip which is nearer 8 to 10% per annum, because that is the rate of growth by which debt is growing exponentially in the US. And if you've got debt, government debt in particular, growing at this clip, you're going to have to get liquidity rising at a very similar rate. And if liquidity rises at that rate, that's monetary inflation. So you've got to start thinking seriously about moving away from a 60-40 asset allocation towards something which is nearer, 60%, let's say, for equities, 10% cash, 10% bonds, conventional bonds, maybe 10% tips, and 10% in gold and Bitcoin. And this is a different asset allocation, but I think it makes a lot more sense in the world that we're entering.